Are you thinking of buying a property? Or maybe your remortgage is fast approaching, but you've got a little bit of bad credit and you're worried about it? Don't stress, we've got you on this one. In this video, I'm going to explain what options might be available to you if you've got a little bit of bad credit, and how lenders might look at your application. Hello guys, my name's Chris Duncan, and I'm a qualified mortgage broker. In this channel, we help educate and give out mortgage tips for anybody with bad credit who's looking to secure a mortgage. If you're new to the channel, then please think about subscribing. What is bad credit? Now, at the age of 18, everybody starts off with a blank and clean credit report. Now, this will just contain some basic information like full name, date of birth, current address, any credit that you have, or any accounts that you have active, like a current account or a mobile phone, and it will also show your history with those providers. Things like phone contracts and insurance providers are a great way of starting to build a credit report. Not only will you get the benefit of having the phone or the contract in place, but you will also benefit from showing a potential lender that you're a good payer. Now, the negative downside to this is potentially if you're a bad payer, you will start to demonstrate this to a lender and your score will decrease accordingly. Now, unfortunately, finance isn't taught in schools, something that I feel quite passionately about. But I know at the age of 18, I wasn't really thinking about my credit report. I don't even think I knew I had one. We've all been there at this stage of our lives where our social life is more important than paying the bills. At age 18, I certainly wasn't thinking about home ownership. I was thinking about going out with my friends. But what most people don't realise is the mistakes that you make at the age of 18 follow you around for 6 years. So potentially at the age of 24, you could still be paying for a mistake that you made at the age of 18. At age 18, I certainly wasn't thinking about getting a mortgage. But fast forward 3 years, and I'm 21 years old, and my little boy is on his way. And all of a sudden, I needed to get a mortgage. Now, if you have made mistakes at the age of 18 or earlier on in life, it isn't all doom and gloom, because there's lenders that will lend if you've got a little bit of bad credit. Now, there's two types of lenders. There's lenders that will credit score, and there's lenders that will credit search. Now, the difference between the two is quite vast. A lender that will credit score will basically run you through a system, have a look at your credit report and the score that's on there, and compare it to their internal scorecards. A lender that will credit search will look at your profile and each individual account you have in place and compare it to their lending profile and see if it's something that fits with them. All lenders have a different appetite for bad credit mortgage applications. Most high street lenders have a computer says no attitude to these kinds of applications. So basically, you key your application and the computer will give a yes or a no answer based on your score. Further into the application, an underwriter might ask further questions about what they can see on your credit score. On the flip side to this, a lot of building societies and subprime lenders will credit search instead of credit score. Now, what does this mean, I hear you say? Well, a lender that will credit search over credit score will look at each individual point on your application to see if it's something that fits with them. So you're not at the mercy of a computer says no approach. Now, there are 3 advantages to using this kind of lender over the high street. The first main advantage is it lets you have your say. So if you've got a little bit of bad credit, let's say due to a relationship breakdown or a bereavement within the family, we can put this on your application and explain it to an underwriting team. They won't ignore it and they certainly won't forget it, but it gives them a little bit of background and it'll draw a picture of the reasons why you've ended up in this position. Point number 2, relaxed criteria. A lot of building societies and subprime lenders have a little bit of a relaxed approach to lending, and some of their criteria is a little bit easier to get through. For example, mobile phone bills. Some lenders will ignore any arrears that have been gathered on a mobile phone. Why is this? Now, this can be because it's quite common to see that people have got multiple mobile phone contracts, iPads, Apple Watches and various other things, and they know from time to time that payments either get missed or it can be due to an admin error, which is more commonly known. Point 3, quick turnaround. Because these lenders aren't as busy as the high street, we often find that we can get these mortgages from application to offer much, much quicker. Now, bad credit isn't anything to be ashamed of, and it's quite common, probably more common than what you think. I predict that in 2023, we will see an increase in bad credit applications as the cost of living increases, certainly with things like gas and electric, I'd expect to see more arrears around this type of utility. In 2023, I expect lenders to adapt their criteria for people that have got arrears with gas and electric. As I've said, bad credit is really common, and there's loads of reasons why people commonly fall into the trap of having bad credit. Now, these can be a divorce. Quite often, during a relationship breakdown, there can be discrepancies on who's paying what and how things move forward. So quite often we find that we have secured and unsecured arrears on the exit to a divorce. Bereavement. It's quite common that during a bereavement, if it's a close family member, that you might not be fit for work and you might have a little bit of time off. And sometimes we found, particularly with utilities and unsecured debts, that these can slip into arrears. Loss of jobs. In an economic downturn, it's quite common to see loss of jobs, and people don't always have the savings in place to cover their bills while they find employment again. It's always advised that you have 3 to 6 months worth of savings in your account to cover any potential job losses. Illness. Now, we all can't help getting ill, but what we can help is having the correct cover in place. This is where having something like income protection, critical illness, or life insurance could help you keep up to date with bills during sickness or illness. If I was looking to secure a mortgage in 2023, this is exactly where I'd start. I'd start by getting a copy of my Check My File credit report. Now, the reason why I do this is it's the only multi-agency credit reporting system that will allow you to look at 3 credit reference agencies on one document. So not only is the document easy to read, it's free for 30 days, it will also show us the information that Experian, TransUnion and Equifax all hold on you. It's quite common between these 3 credit reference agencies that we find varying information between them. For example, in the past I've seen somebody have a late payment on a mortgage on one credit reference agency but not on the other, and it simply was an admin error. Believe it or not, discrepancies between the 3 are quite common, and this is another reason why we'd always opt to see your Check My File credit report. There is a link in the show notes to obtain a copy of your Check My File credit report. This is free for 30 days. Now, obviously, it's not good to have bad credit, and it will cause the odd complication when it comes to a mortgage, but it doesn't mean you can't secure a mortgage, despite what your high street lenders have told you. Thanks so much for watching the video. I hope you found the content in it useful. If you have any questions, then please leave them in the comment section below and I'll get back to you. If you haven't already, then please think about subscribing to the channel.